In Chapter 20, we looked at the basics of national income accounting and the circular flow of expenditure and income.
We begin our journey with a domestic producer who is a manufacturer of maple syrup. From the total income generated by his business, some of it is paid to his employees in the form of wages and salaries. Unfortunately, the employees do not get to keep all their wages, as a percentage is collected by the government in the form of taxes. After paying taxes, their net income is then brought home to the domestic households to be used as they see fit. Often, the households will take a percentage of this remaining income and place it in their savings account at the bank to be used at a later date. After deducting taxes and savings, the remaining amount is then spent on both durable and non-durable goods as well as services. As we can see here, this consumer is purchasing bitcoins on the internet with some of his income. Next, he decides to go buy some groceries for his dinner. However, he discovers not everything he wants is readily available at the local store. Thus, some of the domestic consumption expenditure of households is redirected to imports to bring these goods into Canada. Furthermore, part of the maple syrup produced by his workplace is demanded by foreign countries and exported out of Canada for sale to these countries. Meanwhile, the money deposited as savings by the domestic households has entered the financial system, where it is loaned out to earn interest. We can see here our maple syrup manufacturer has borrowed some of this money so that he can build larger factories and increase production. While all this is happening, the government has taken the money generated from taxes and used it to provide goods and services to the households. With these activities, called government purchases, they are adding to the total value of national income. And now that our circular flow of income and expenditure diagram is complete, let us briefly cover the methods of calculating national income.
We looked at three methods for measuring national income or output to arrive at the gross domestic product, GDP. One method is the total value added from domestic production. Production occurs in stages. Most firms produce outputs that are other firms' inputs, each firm adding value to production of the total output. Each firm's value added being equal to revenues minus non-labor costs. Thus, total output, GDP, is the sum of each firm's value-added contribution. A second method is the total income generated by domestic production. GDP is the sum of factor incomes such as wages and salaries, interest, and business profits, plus other claims on the value of output like indirect taxes, net of subsidies, and depreciation of existing capital. The third method is the total expenditures on domestic output. This is done using four broad expenditure categories or national accounts. The sum of actual components equaling actual GDP. The components being CA, actual consumption expenditure, IA, actual investment expenditure, GA, actual government purchases, and XA, actual net exports. However, because of the circular flow of expenditure and income, it does not matter which method is used. Each method of measuring national income or output gives the same total, the same gross domestic product, GDP.